You're sitting across from the world's greatest investor, and he's about to reveal something most financial advisors won't tell you. Not some get-rich-quick scheme. Not some fantasy about sipping margaritas on a beach. But the raw, unfiltered truth about what it really takes to retire in 10 years. I'm talking about real numbers, real strategies, and real freedom. And here's the shocking part. Most people are calculating their retirement completely backwards. They're asking the wrong question entirely. Stay with me, because what I'm about to share could change everything you thought you knew about money and freedom. You know, people approach me constantly with the same question: Warren, how much do I need to save to retire? And my answer always surprises them. It depends. I can see the frustration in their eyes. They want a number, something concrete. But then comes the follow-up, and this is where it gets interesting. Okay, but what if I want to retire in 10 years? How much do I need to invest every single month? Now, that's a better question. That's specific. That's actionable. I'm 94 years old, and honestly, I've never truly retired. Probably never will. But over these decades, I've watched thousands of people navigate retirement, some brilliantly, some catastrophically. And I've discovered something crucial that most people miss entirely. Retirement isn't about hitting some magical number and then stopping work. That's the misconception that destroys most retirement plans. It's about having enough money that work becomes optional, that you don't have to work if you don't want to. That's freedom. That's what we're really discussing here. The fundamental principle. So today, I'm going to walk you through the mathematics, not fantasy math, but the real calculations for someone who genuinely wants financial independence in 10 years. Let's start with the most critical question that almost everyone gets wrong. How much do you actually need to retire? Here's where most people's thinking falls apart. They focus on arbitrary targets. I need $1 million, or I need $2 million. But that's completely backwards. The question isn't how much you need. The question is, how much do you spend? Your retirement number is fundamentally based on your spending, not some random target you pulled from a magazine article. Let me introduce you to a powerful concept called the 4% rule. This rule states you can safely withdraw 4% of your portfolio annually without running out of money. The math is beautifully simple. If you spend $40,000 yearly, you need $1 million, because 4% of $1 million equals $40,000. If you spend $80,000 annually, you need $2 million. If you spend just $20,000, you only need $500,000. See the pattern? Your spending determines your number entirely. Now, the 4% rule isn't perfect. Nothing in finance is. It assumes approximately 7% returns after inflation, a balanced portfolio of stocks and bonds, and about 30 years of retirement. If you're retiring at 65 and living to 95, this works remarkably well. But here's the critical adjustment. If you're retiring at 50, you might need to be more conservative, perhaps 3.5%. Retiring at 40, maybe 3%. The earlier you retire, the more conservative you must be, because your money needs to last decades longer. The real numbers. Let's work through actual scenarios with real math. Say you want to spend $50,000 annually in retirement, a reasonable middle-class lifestyle in most of America. Using the 4% rule, you'd need $1.25 million, because 4% of $1.25 million equals $50,000. That's your target. That's your retirement number. Now comes the fascinating part. How do you reach $1.25 million in 10 years? You need to know two critical things. First, how much have you already saved? Second, what return will your investments generate? Let's discuss returns. I can't predict the future, nobody can, despite what they claim on television. But historically, the stock market has returned approximately 10% annually. Some years more, some years less, but averaging around 10%. That's our baseline assumption, 10% per year. Yes, it's optimistic. It assumes you're fully invested in stocks and the next decade is average. But it's reasonable enough for planning. Scenario one, starting from absolute zero to reach $1.25 million in 10 years at 10% returns, you'd need to invest approximately $6,500 monthly. That's $78,000 annually. That's substantial. Most people simply cannot do this unless they're earning a high income and living dramatically below their means. Scenario 2. You've savet vienas šimtas, nulis already. Now you only need to reach $1.15 million with new investments. At 10% returns, you'd need about $5,000 monthly, $60,000 annually. Still challenging, but more achievable if you're serious. Scenario 3. You've accumulated $250. This is where the mathematics becomes more favorable. That $250,000 grows independently at 10%, becoming approximately $650,000 after 10 years. You only need to save another $600,000 through monthly investments, requiring about $3,000 monthly, $36,000 annually. That's realistic for many dedicated savers. Notice the pattern? The more you've already saved, the less you need to invest monthly because your existing money compounds and grows automatically. That's the extraordinary power of starting early. The power of compound interest working silently in your favor. If you begin saving at 30, by 40, you've got momentum. But if you wait until 40 to start, you're beginning from zero and the numbers become brutally difficult. Critical assumptions and risks. Let me address something vital, the assumptions we're making here. That 10% return, that's a significant assumption. Some years the market surges 20%, other years it crashes 20%. And if you retire immediately after a major crash, you could face serious trouble because you're withdrawing money from a depleted portfolio and it might not recover fast enough. This is called sequence of returns risk, and it's one of the biggest dangers in early retirement. So what do? You build in a margin of safety. You plan for lower returns, maybe 7% or 8% instead of 10%, or you save more than you think you need, creating a cushion for when things inevitably go wrong. Or you stay flexible. If the market crashes right when you're planning to retire, you work another year or two. That's my recommendation. Flexibility. Don't lock yourself into some rigid plan. Have a target, absolutely, but be willing to adjust based on reality. Now, let's examine the other side of this equation. Spending. Here's something powerful. The less you spend, the less you need to save. And the less you need to save, the easier early retirement becomes. If you can live on $30,000 annually instead of $50,000, you only need $750,000 instead of $1.25 million. That's a massive difference, $500,000 less you need to accumulate. If you can live on $20,000 yearly, you only need $500,000. I know what you're thinking. Warren, I can't possibly live on $20,000 a year. And maybe you can't. Maybe you genuinely need more. But many people could live on substantially less than they believe, especially with strategic choices moving to a lower cost area, living more simply. There are two paths to early retirement. You can earn more and save more, or you can spend less and need less. Most people obsess over the first path, thinking, I need to make more money. But the second path is often easier and more powerful. Because if you cut spending by 20%, you need 20% less to retire, and you can save 20% more because you're spending less. It's a double benefit. You need less and you save more simultaneously. That's the magic of living below your means. Aggressive scenario, 1245, 1630. Let me give you a different example, a more aggressive scenario for someone truly serious about retiring in 10 years. Say you're 35 years old, earning $80,000 annually, and you're absolutely committed to retiring at 45. Here's the plan. First, you slash spending aggressively. Let's say you live on $30,000 yearly. That's not easy, but it's doable, especially when you're motivated by a clear goal. That means you can save $50,000 annually from your $80,000 income. That's a 62.5% savings rate, extraordinarily high, but possible. At a 62.5% savings rate while living on $30,000 yearly, you'd need $750,000 to retire using the 4% rule, because 4% of $750,000 equals $30,000. Can you reach $750,000 in 10 years? If you're saving $50,000 annually with 10% returns, after 10 years, you'd have approximately $800,000. That's enough. You'd hit your target and could retire at 45. Would I recommend this? Would I tell someone to follow this exact plan? Maybe, if they're genuinely committed and understand the risks. But it's aggressive, really aggressive. It assumes high returns, low spending, no major emergencies, and leaves minimal room for error. If the market crashes right when you're planning to retire, you might need to wait. Social Security and retirement layers. Let me discuss something people frequently forget. Social Security. Most people planning retirement completely overlook Social Security, and that's a mistake because it can be substantial. The average Social Security benefit is approximately $1,800 monthly, $21,600 annually. Now, if you retire early, before 62, you won't receive Social Security immediately. But once you hit 62, you can start claiming it. That $21,600 annually reduces how much you need from your portfolio. Instead of withdrawing $50,000 yearly, you only need $28,400, which means you need a smaller portfolio, maybe $710,000 instead of $1.25 million. That's a significant difference that makes early retirement considerably more achievable. When I think about retirement planning, I visualize it in layers. Layer one is Social Security, your foundation, your base. It's guaranteed income for life. Layer two is your portfolio, your savings and investments that you're building during your working years. Layer three is flexibility, the ability to adjust, to work part-time if needed, to cut spending if the market crashes. That flexibility gives you security. That's what enables you to retire early without taking insane risks. Investment strategy. Now let's discuss something practical. Where to invest this money you're saving monthly? Because it's not enough just to save. You must invest it, put it to work, let it grow. And where you invest determines your returns. And your returns determine whether you hit your target. I've always been a stock investor, equities, ownership in businesses, because over the long term, stocks outperform everything else. Bonds, cash, real estate, everything. The stock market has returned approximately 10% annually for the last century. Some decades more, some decades less, but averaging 10%. If you're saving for 10 years trying to build wealth quickly, you need those returns. You cannot get there with bonds. Bonds might return 4% or 5%. That's insufficient to reach your goal in 10 years. You need stocks. You need equity exposure. What stocks should you buy? If you're a sophisticated investor who understands businesses and can read financial statements, you can select individual stocks, find great companies at good prices, build a portfolio of 10 or 15 holdings. That's what I do. That's what I've always done. But most people can't do that. They don't have the time or knowledge. And that's perfectly fine. That's what index funds are for. An index fund simply owns everything. The S&P 500 index fund owns the 500 largest companies in America. Apple, Microsoft, Google, Coca-Cola, Johnson & Johnson, everything in one fund for basically no cost. Historically, the S&P 500 has returned approximately 10% annually. Some years it surges 30%, other years it drops 20%, but on average over long periods, about 10%. That's what you need to reach your retirement goal. If I were starting from scratch trying to build wealth for retirement, here's exactly what I'd do. I'd open a retirement account, an IRA or 401k. Every month I'd invest in a low-cost S&P 500 index fund automatically, like clockwork. $3,000 monthly or $5,000 or whatever amount you've calculated you need. And I do that every single month for 10 years, rain or shine, bull market or bear market. Doesn't matter. Just keep investing, keep buying, keep accumulating shares. This strategy has a name, dollar cost averaging. And it's powerful, genuinely powerful, because when you invest the same amount monthly, you buy more shares when prices are low and fewer shares when prices are high. Over time, that averages out and you end up with a favorable average price. You don't have to worry about timing the market, about trying to figure out when to buy and when to sell. You just buy every month, consistently. That's the strategy. That's how you build wealth for retirement. Taxes and accounts. Let me talk about taxes, because taxes matter tremendously. If you're investing in a taxable account, you're paying taxes on dividends and capital gains every year. Those taxes eat into your returns and slow down your compounding. But if you're investing in a retirement account like a 401k or IRA, you don't pay taxes until withdrawal, which means all your gains compound tax-free for years, for decades. That's an enormous advantage that can add hundreds of thousands of dollars to your final balance. Let me show you the difference with concrete numbers. Say you invest $5,000 monthly for 10 years at 10% returns. In a taxable account, after paying taxes annually, you might end up with approximately $900,000. But in a retirement account where you don't pay taxes until withdrawal, you'd end up with over $1,050,000. That's a $150,000 difference just from tax deferral. So use retirement accounts, max them out. 401k first, because many employers match your contributions. That's literally free money. Then an IRA, then a Roth IRA if you qualify. Get as much money as possible into tax-advantaged accounts. That's how you maximize your returns. Market crash. Let me address a concern people always have. Warren, what if the market crashes? What if I'm halfway to my goal and the market drops 40%? That's a valid concern, because markets do crash. They crash regularly. Every 7 to 10 years, there's a major crash, a bear market, a recession. It happened in 2000, 2008, 2020, and it'll happen again probably sometime in the next 10 years. So if you're on this 10-year retirement plan, you're almost certainly going to experience a crash. The question is, what do you do about it? There are two ways to think about a crash. Most people view it as a disaster, a catastrophe. They panic, they sell, they lock in their losses. But that's exactly wrong. That's the worst possible thing you can do. A crash, if you're still in the accumulation phase, if you're still saving and investing, is an opportunity, a gift. Because when the market's down 40%, everything's on sale. Stocks that were expensive are now cheap. And you're still investing every month. You're still buying. So you're buying at low prices, accumulating more shares for the same amount of money. And when the market recovers, and it always recovers, those shares you bought cheap are worth substantially more. So don't fear crashes. Embrace them. As long as you're still working, still saving, a crash is your friend, an opportunity to buy cheap. Now, there is one exception. If you're retiring soon, like in the next year or two, a crash can be problematic because you're about to start withdrawing money. If your portfolio is down 40% and you're withdrawing from a depleted portfolio, that could be dangerous. That's why, as you approach retirement, you should shift some money out of stocks and into bonds. Not all of it, but some, maybe 20% or 30%. Bonds are more stable. They don't crash like stocks do. They provide a cushion, a buffer. If the market crashes right when you retire, you can live off bonds for a year or two while you wait for stocks to recover. That's the strategy for managing risk. Healthcare reality, 33 to 0, 36 to 30. Let me discuss something else that destroys many early retirement plans. Healthcare. If you're retiring early, before you're eligible for Medicare, healthcare is a massive issue. Medicare starts at 65. But if you're retiring at 55, or 50 or 45, you've got a gap, a period where you need health insurance. And it's expensive, really expensive. Private health insurance for a couple can be $1,000 to $2,000 monthly. That's $12,000 to $24,000 annually just for health care. You need to budget for that. You must include it in your retirement spending calculations. If you thought you'd spend $50,000 yearly and then realize you need another $20,000 for health care, now you need $70,000, which means you need a bigger portfolio, $1.75 million instead of $1.25 million. That's a massive difference. Many people don't think about this. They reach retirement and they're shocked. Don't be shocked. Plan for it. Early retirement isn't just about having enough money to live on. It's about having enough to cover all your expenses, health care, taxes, insurance, emergencies. And you need a cushion, a margin of safety, because things go wrong. Cars break down, roofs leak, people get sick. If you've planned everything perfectly with zero margin for error, you're going to encounter trouble eventually. So be conservative, build in a buffer, save more than you think you need. Spend less than you think you can. That's how you make early retirement work successfully. Real world example, 36 Treaty 3915. Let me share a story about a friend of mine. He retired at 55 about 10 years ago. He did everything right, saved aggressively, invested in index funds, built up a portfolio of approximately $1 million. He calculated he needed $40,000 annually, and 4% of $1 million is $40,000. So he thought he was set. For the first few years, it worked beautifully. The market was rising, his portfolio was growing, even as he withdrew money. He was living the dream, traveling, playing golf, spending time with grandchildren. But then 2022 happened. The market dropped 25%. Suddenly his $1 million portfolio was worth $750,000, and he's still withdrawing $40,000 annually. But now that's more than 4%, it's over 5%. At that rate, he's going to run out of money. You know what he did? He went back to work part-time, just some consulting work. Not because he wanted to, but because he had to, because his plan didn't have enough margin of safety. Now, this isn't a tragedy. He's still better off than if he'd never retired. The part-time work gives him something to do. But my point is, if he'd been more conservative, if he'd saved a little more or waited a few more years, he wouldn't have needed to return to work. He'd have genuine freedom. That's why margin of safety matters. That's why you need to be conservative with your planning. Practical recommendations, 39 to 15, 44 to 0. Let me give you my honest recommendation for someone who wants to retire in 10 years. First, figure out your spending, your real spending, not what you think it should be, but what it actually is. Track every dollar for a few months, see where it's going. Second, multiply that by 25. That's your retirement number using the 4% rule. If you spend $50,000 yearly, you need $1.25 million. Third, look at how much you've already saved and figure out how much that'll grow to in 10 years at a reasonable rate of return. Let's say 7% or 8%. Be conservative. Fourth, figure out the gap, the difference between what you'll have and what you need. Fifth, divide that gap by 1/2 number of months in 10 years. That's how much you need to save monthly. If that number is impossible, if you can't save that much, then you've got three options. Work longer than 10 years, spend less in retirement, or earn more now so you can save more. Those are your options. Pick one. Retirement planning isn't magic. It's mathematics. Simple math, but honest math. Many people don't want to do the honest math. They want to believe they can retire on less than they actually need. They want to believe the market will always rise, that they'll never have emergencies, that healthcare won't cost much. But that's wishful thinking. That's not planning. Real planning is conservative. It assumes things won't be perfect. It builds in buffers, margin of safety. If you do that, if you're honest and conservative, you can retire early successfully. But if you're overly optimistic, you're setting yourself up for disappointment. The psychology of retirement. Let me discuss one more critical thing. The psychology of retirement. Having enough money is only half the battle. The other half is knowing what you're retiring to. Many people think retirement is just not working. But that's not enough. You need something to do, some purpose, some structure to your days. I've seen people retire with plenty of money and they're miserable because they're bored. They feel useless. So before you retire, think seriously about what you'll do with your time. Hobbies, volunteer work, part-time work you enjoy, travel, learning. You need something. Otherwise, retirement is just emptiness. That's one reason I've never retired. I love what I do. I love investing. I love running Berkshire. I love working with people I respect. Why would I stop? Money is not the reason I work. I've got more money than I could ever spend. I work because it gives my life meaning, purpose. I think many people would be happier if they thought that way. Not how fast can I retire, but how can I find work I love that I'd want to do even if I didn't need the money? Because if you love what you do, retirement becomes less important. You might still want financial independence, the ability to quit if things change, but you're not counting down the days. You're not disparate to escape. You're just living, doing work you enjoy, building wealth as a byproduct. Final summary. I suppose I should wrap this up. How much do you need to invest monthly to retire in 10 years? The answer depends on how much you have now, how much you need to spend, and what returns you get. But as a rough guide, if you're starting from zero and want to spend $50,000 annually, you probably need to invest $5,000 to $7,000 monthly. That's a lot, $60,000 to $84,000 annually. Most people can't do that unless they're earning a high income and living really frugally. But if you've already got money saved, if you've got $100,000 or $200,000 already, the numbers get easier. You might only need $3,000 or $4,000 monthly. And if you're willing to spend less in retirement, if you can live on $30,000 or $40,000 instead of $50,000, the numbers get even easier. You might only need $2,000 or $3,000 monthly. The key is flexibility. If you're rigid, if you say, I must retire in exactly 10 years and I must spend exactly this much, you might be setting yourself up for failure because life doesn't work that way. But if you're flexible, if you say, I'd like to retire in 10 years, but I'll adjust based on how things go, then you've got a much better chance of success because you can adapt. You can respond to reality. Maybe the market does great and you retire in 9 years. Or maybe the market crashes and you wait until year 12. Either way, you're okay because you're flexible. Closing message, 51 to 0, 53 to 30. Here's what I tell a young person, someone in their 30 seconds or 40 seconds thinking about early retirement. Start now, today. Start saving, start investing. Even if you can't save enough to retire in 10 years, even if the math doesn't work yet, because every dollar you save now compounds, grows, gives you more options later. And the habit of living below your means, of investing regularly, that's the most valuable thing, more valuable than any investment return. Because if you build that habit, if you make it automatic, you'll reach financial independence eventually. Maybe not in 10 years, maybe in 15 or 20, but you'll get there, and when you do, you'll have freedom. Financial independence isn't really about retirement, it's about options. It's about not being forced to do things you don't want to do. Maybe you use that independence to retire completely, to stop working. Or maybe you use it to switch careers, to start a business, to work part-time, to take a year off and travel. The point is, you've got choices. You're not trapped by needing a paycheck. That's freedom. That's what we're really after. I'm 94 years old now, and I've been financially independent since my 30 seconds, probably earlier, actually. Not because I made a fortune overnight, but because I lived below my means, invested consistently, and let compound interest work its magic over decades. You can do the same thing. It won't be easy. It requires discipline, patience, sacrifice, but it's possible, and it's worth it. Because freedom, real financial freedom, that's priceless. Start today, do the honest math, build in your margin of safety, stay flexible, and keep moving forward. That's how you retire in 10 years. That's how you build a life of freedom.